Good evening, ladies and gentlemen, and welcome to Eyewitness News. I'm your host, Harvey Spector. Let's get right to it. Tonight we're going to be looking at some riveting issues of accounting sent in by viewers all around the world. I've got the finest reporters on standby waiting to answer your questions, so let's get right into it. The first question is sent in by young Patrick Dunton, all the way from South Africa. This is his question. Hi Harvey, was just wondering about the way you treat investment with regards to consolidated group statements. Much love, Patrick. Shout out to you as well, Patrick. Standing by all the way from Argentina is young Ross, ready to answer this question. Over to you, Ross. Thanks, Harvey. Really appreciate this opportunity to show my greatness. First of all, I'd just like to thank you for the question. Great question. The answer is kind of a two-part answer. Firstly, when a parent company acquires a subsidiary, the parent company in its books recognizes an investment as that's the asset that it's now acquired. But when consolidating both companies into the group statements, you look at the company as one entity and one massive company. Therefore, by that logic, if the investment was added into the consolidated statements, you can't have an investment in yourself, because essentially that's what it is. It's an investment in yourself. Also, this investment is recognized by the net asset value of the subsidiary company, which is recognized by the assets minus the liabilities. So if you were to put the investment in as well, it would be double counting. Back to you in the studio. Thanks, Ross. That was a really well thought out and descriptive answer. Nailed that completely. The next question comes in from Mr. Barack Obama from the United States. His question is, goodwill is included in the consolidated statement of financial position, but is it included in the parent or subsidiary companies? With a follow-up question of how it is calculated. I've chosen Sebastian Mafuna all the way from France, but he's currently in Bermuda Triangle, so we're going to have to conference call him in. Over to you, Sebastian.
Thank you, Barack Obama, for that question. It's been great hearing from you again. Anyway, going to the question. Goodwill is basically the future economic benefit arising from an asset that aren't capable of being individually identified and separately recognized. You can find this in your FS for SMEs, chapter 19, which states that goodwill is recognized in the consolidated statements when a company is acquired. It's initially measured at cost and is calculated as the excess of the company's business combination of the acquired interest in the net fair value of the identifiable net assets of the company being acquired. Goodwill is also amortized over its useful life. If you've got a question about that, Barack, you can usually just assume it's 10 years. It's not given to you, or you cannot find it. And lastly, it's not appear in the separate financial statements of the subsidiary or the parent, basically because they are internally generated assets, and that cannot appear in your statement of financial position and whatnot. Anyway, a mouthful from me. Back to you, Ross, in the studio. See you later.
Well, are we on here? Okay. Thanks, Sebastian. Another great answer. Clearly an author of a textbook or something. Our next question is from a young Asif, Moscow, Russia. He would like to know, for the same piece of land, how come it is valued at different amounts in the group and individual company statements when the group's policy is not to revalue land? Young Peter from Northumbria, England, will be answering this question. Over to you, Peter.
This is Peter Jessup. I'll be answering question C with a selfie, mainly because I've no one else to take this video for me. So here it goes. So question C starts off with the subsidiary owning land worth 30 million, but in the group statements it is recognized as 33,050,000. My question wants to know is, this is the same land and the group's policy is not to revalue land, so why is there a difference in the value of this land? So to answer this, let's go to our good friend IFRS for SMEs and see what it has to say. And we'll go to section 19.11, cost of a business combination. The acquirer shall measure the cost of a business combination as the aggregate of A. We go to part A. the fair values at the date of exchange of assets given, liabilities incurred or assumed, and equity instruments issued by the acquirer in exchange for control of the acquiree. So that can tell us and explain why the fair values of this land differ. And the reason would be is that when the subsidiary bought the land, it would have measured it at cost, which would have been 30 million. But now, when the group bought the subsidiary, and in essence bought the land, they would have bought it at that fair value at that time, which would have been the 33,050,000, and that is why they differ, because the fair value at the time of exchange. So that's my answer to question C. Hope you enjoyed my selfie video, and yeah, cheers.
Thanks, Peter. Really appreciate that quality insight into land and revaluation. Our next question is from Mr. Max Price of UCT, bit of a controversial character. He would like to know why a liability from a subsidiary to the group is not shown on the consolidated statements. Answering this, we've got the young and beautiful Joyce. Over to you, Joyce.
The question deals with intercompany transactions. Before I go any further, I want to explain what intercompany transaction is. So it occurs when a unit within an entity enters into a transaction with another unit within the same entity. So the way you go about thinking about it is that just this circle here, this is the group. And within your group, you have smaller units. So this could be the parent company and then its subsidiaries. So this whole thing is a group. So when we deal with intercompany transactions, that's when these parties within the larger circle are entering a transaction with each other. So in this case, we're given that the parent company got a loan from one of its subsidiaries. So the parent company got a loan of 350,000, while the parent company will be able to record that loan in the financial statements as a liability. We cannot record it as a transaction within the group. So what we'll do is that the parent company will have a loan amount of 350,000 under the statement of financial position, while the subsidiary will record a receivable, which is an asset. And that's what you would do on a normal basis, like if you enter a transaction of an arm's length with unrelated parties. But what IFRS requires of us is that when we consolidate the group or we prepare the financial statements of the group, is that we eliminate these transactions against each other. Because I mean, you will agree with me that basically it's just a transfer of cash from the entity to the parent, and this is within one entity. So it makes no point for us to record it as a liability of the group, because it's just a movement of cash within the entity. And we do this because IFRS requires us to report on reliable information, and that it must be relevant. So yes, that's question D. If you have any questions, come and ask me afterwards.
Sorry, ladies and gentlemen, it was just such a phenomenal answer, I couldn't help but applaud. My producers are trying to wave me down here. It seems that all we've got time for today is those 4 questions. We'd just like to thank all our viewers at home for the support and tuning in, especially those 4 viewers who sent in the questions. Absolute sizzlers. I really had our reporters on the ropes there. Lastly, we'd just like to thank our sponsors, USN, Red Bull, National Geographic, and the ANC. Without you guys, this wouldn't be possible, so thank you very much.